One of my common financial goals every single year is to turn more active income into passive income. This is the process of taking your regular 9 to 5 income that you get for whatever job that you do and taking a chunk of that and investing it, putting it to work, turning it into passive income. As such, in today's video, we're going to take a look at the exact process on how you can build a portfolio to earn $1,000 in dividend income every single month. But before we begin, do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. When it comes to dividend investing, especially if you're new to the idea of dividend investing, I'm here to tell you that dividend investing is a process. There's a lot of new investors that look into dividend investing and they see, wow, I invest a big chunk of money for such a small return. Well, remember, the dividend income you receive is just a portion of the total return. Dividend investing is the combination of share price appreciation as well as dividend income. So although dividend income isn't great in the first few years, it's a process. It's not a get-rich-quick scheme. And that's why a lot of new investors shy away in the early years. Dividend investing isn't the most exciting form of investing, but if you allow this process to take shape and you're patient enough, the rewards are massive. All right, so let's begin by first taking a look at a hypothetical situation. I want you to first understand the process of compounding dividends and how waiting and being patient to allow the process to play out will pay, no pun intended, dividends. The power of compounding dividends is the exact process that Warren Buffett has used for years and decades. The idea is to not only invest on a regular basis your own money, but to take the dividend income that you're getting paid and reinvest that as well to increase your share count. And if you're investing in stocks or ETFs that increase their dividends on a regular basis, now you have more shares and they're going to pay a higher dividend per share. So that next year, your dividend income is going to go higher. And you continue this process year in and year out, and you will see this dividend snowball build and build in your favor. This exact process can really be set up automatically through your brokerage by turning on what's called the DRIP system or the dividend reinvestment plan. That means that anytime a particular stock pays you a dividend, you can tell your brokerage to reinvest that automatically. Again, the process starts slow, but it starts building and building, going faster and faster in your favor. So let's take a look at a hypothetical situation. Let's begin by looking over the entry points. We're going to go with a starting investment of $50,000. Now, this may be higher or lower than what you are starting with or already have, but the process will be the same. We're going to add on a monthly basis $1,200 per month, and our starting portfolio dividend yield is 3%. We're going to say that on average, annual dividend growth is about 12%. And average annual share price growth is 12% as well. So as you can see here from this chart, we started with $50,000 invested. We're going to use a share price of $50 per share. That could be any price that you want to put in there right now. That'll buy us 1,000 shares. If we're buying a $50 stock, $50,000, now we own 1,000 shares. So the first year, our dividend per share is $1.50, which means we will get paid $1,500 in dividend income, which averages out to only about $125 per month. Nothing crazy to write home about, and that's usually the case on why new investors stop with the dividend process. They see the first year and they bail. However, if we take that $1,500 and reinvest it, that adds an additional 26 shares in this scenario. In addition to the fresh invested dollars we added throughout the year, we now have a total of 284 new shares going into year two. As stated above, the dividend will grow 12% each year, making it a dividend growth stock. So now instead of paying $1.50 per share, they pay $1.68. And our annual dividend income is now $21.57 on that year. Because again, they're paying a higher dividend and we have more shares. Now I can already sense some of you down in the comment section saying, well, where do you find dividend growth like that? Well, two quick names come to mind. AbbVie, which is a position I've held for the longest in my portfolio, stock ticker ABBV. That company pays not only a higher dividend yield than our hypothetical situation, but it also has fast dividend growth. What about Broadcom? We're going to use that in our situation today as well. Stock ticker AVGO. one of the best dividend growth stocks that are out there. We're talking about dividend growth in excess of 20% per year over the past 5 years. So looking back at the chart here, if we continue this same process by taking the dividend income, reinvesting it, and adding our new money, and allowing the dividend company to keep increasing their dividend each and every year, you can see that you would generate more than $12,500 in annual dividend income, giving you more than $1,000 in dividend income per month. Again, this is a hypothetical situation. The idea behind it is for you to see the process and the true power of compounding dividends, investing in high-quality companies that have shown their ability to increase their dividend year in and year out. And you are, in the meantime, increasing your share count over time. So that's, again, hypothetical. But now let's take a look at an actual example. If we were to invest in 3 different stocks or ETFs, we're going to begin with one of my favorite ETFs that's out there, which is the Schwab US Dividend Equity ETF, otherwise known as SCHD. This ETF is beloved by many dividend investors out there today due to the fact that they have a well-diversified portfolio, they pay a strong dividend yield, and they have strong dividend growth. Let's first take a look at the ETF's top holdings. As you can see, Broadcom, Amgen, Verizon are the top 3 positions, followed by the Home Depot, AbbVie, Coca-Cola Company, Texas Instruments, Merck, BlackRock, and PepsiCo. These top 10 holdings account for roughly 40% of the entire portfolio, and in totality, SCHD has 104 total positions. So now let's take a look at the dividend stats. As you can see over the trailing 12 months, SCHD has a dividend yield of 3.5%. That dividend has increased for 12 consecutive years, and the ETF has a 5-year dividend growth rate of 13%. So now let's assume that we invested $10,000 in SCHD starting in 2013, and we're going to add $250 every single month, which equates to roughly $3,000 per year. By this year, 2023, we would have invested $40,000, and that $40,000 based on just share price appreciation of SCHD is now worth over $75,000. But let's focus on the dividend, because we started year 1 by only earning roughly $250 per year in dividend income. But fast forward to 2023, we are now talking about dividend income in excess of $2,600. That is phenomenal growth right there alone. But now let's move on to 2 other stocks, one of them being a favorite dividend growth stock of mine, which is the Home Depot, stock ticker HD. Now in this example, we're going to look at a stock with a little bit lower yield, but also that strong dividend growth, which makes a huge difference. HD currently has a dividend yield of 2.4%, but they have a 5-year dividend growth rate of 15.2%. The company has increased their dividend for 14 consecutive years and counting. If we do the same thing that we did with SCHD and invest $10,000 back in 2013, in year 1, we would be earning less than $200 in dividend income. However, by compounding our dividends and adding $250 per month through 2023, we would have $40,000 invested, and the dividend income now would be nearly $2,400. The market value of our shares would be worth over $100,000 as well. Remember, dividends are just part of the total return equation. The Home Depot has been a fantastic dividend growth stock over the years, but now let's transition to the best dividend growth stock that's been on the market over the past few years, and that is Broadcom, stock ticker AVGO. For years, Broadcom has kind of flown under the radar as a high-quality chip company, a value chip company. However, over the past few years, their performance has been second to none. Well, second to maybe NVIDIA. That growth is expected to continue with the growth of AI. Looking at the dividend stats here, you can see Broadcom pays an annual dividend of $21 per share, which equates to a dividend yield of 1.9%, so even lower in terms of yield. Over the past 5 years, this dividend has grown at an average annual clip of 21.3%, which is just incredible. And the company has increased their dividend for 12 consecutive years. So now looking at the chart, if we invested that same $10,000 in AVGO back in 2013, we would have earned a dividend income of $166. By adding just $3,000 per year or $250 per month and reinvesting the dividends that we get paid every year, by 2023, you can see how those dividends would have compounded to nearly $7,000. Broadcom has been one of the strongest compounders of wealth over the years, giving investors both strong share price appreciation, especially this year when shares have doubled, but also through strong dividend growth. So now to summarize this, we've invested $10,000 into SCHD, $10,000 into the Home Depot, and $10,000 in Broadcom back in 2013. So if we continue to add$250 per month into each of these three investments, so totaling $750 per month in fresh new money added to our portfolio, and we do this every single month, and we also compound the dividends that we receive on a quarterly basis, add those back in to increase our shares into companies and ETFs that increase their dividend every year, this is where we're going to end up. We're going to be looking at dividend income in excess of $12,000 per year, which means we would be earning on average $1,000 per month. We would be earning $26.62 from SCHD on an annual basis, $23.87 from the Home Depot on an annual basis, and $69.70 from Broadcom on an annual basis, totaling $12,019. And that just is going to continue to increase moving forward as long as we stay invested. And when you looked at those charts that I put together, you can see that the dividend income is increasing at a faster rate every year because the amount of money that we have invested and continue to invest only grows faster. This all goes to show you that the power of compounding is real. And a lot of investors are always looking for that get-rich-quick scheme. But if you have time on your side, a long-term horizon, a patient investor, dividend investing can be very rewarding. When it comes to investing for me, I'm always looking for high-quality companies first and foremost, and these companies focus on returning money to shareholders. Dividend growth stocks are one of my favorite types of stocks to invest in. These are companies that are increasing their dividend at an average annual rate of 10% or more. Because remember, when it comes to investing, dividends are just part of the equation. Dividend investing is a total return. You have your dividend income as well as your share price appreciation. So if we were to look at and invest $10,000 to start and adding $3,000 to our portfolio every single year, over that time span, now looking at 2023, those three investments would now be worth $75,504 for SCHD, over $100,000 for Home Depot, and nearly $375,000 for Broadcom. Again, in totality, we invested $40,000 in each of these three positions. Clearly, Broadcom is a huge outlier, but who is here to say that you won't find the next Broadcom? There are thousands of companies out there, smaller cap, mid cap companies that are also making their way up. Everyone started somewhere. So you always want to be able to do your own due diligence. Look into the company's fundamentals. See how their free cash flow is growing and see how well the management team is able to reinvest free cash flow to build growth moving forward. If you enjoyed today's video, do me a huge favor if you haven't done so yet. Smash that like button as I truly appreciate it. I put these videos out for free and I hope you really do appreciate them. So help me out by pushing this further on the algorithm. Share it with a friend as well and we'll see you in the next one. Take care.